Awesome! Congratulations, guys. You've got the basics down. You have the foundation, you have the skills, and you understand really exactly what you're going into, which is super smart. Like any investment you're making, or any sort of factor, influencer, indicator, or technical analysis, anything you're using, I think it's super, super important to actually know like what actually makes it work. And I didn't know for a long time what made a lot of technical indicators work until I actually wrote 9 to Noon, and then I went and I researched and I was like really figuring out the nitty gritty because I'd spent so much of my time up to that point, like narrowing down. Like you've got sort of all the stuff in the marketplace, and you have tons and tons of people that are like, hey, do this, do this, do this, do this, do this, and a lot of it just doesn't work. So a lot of the time initially is kind of spent figuring out, okay, well, what is that, stuff that actually does work, and then you get to go and dive deep and really say, okay, well, now that I know that this works, how can I understand what actually happens with it? And the moment that you do that, like it's super cool because like you get a really deep fundamental understanding of it. So like that's sort of the goal with this is to figure out how to actually do this, how to actually apply it, and then to have turn that into the most money possible, which is just super super cool and super fun. And she has this example here that I think is just amazing, and it's a really cool one. She talks about her mom, and her mom was a really really intelligent bridge player. Like my grandma plays bridge too. Like bridge, it's just like a card game. I don't know anyone that it's just a card game, okay? And she was really, really good at like counting cards. Like she could see a deck and she could count the cards in the deck. She would teach people how to count cards. And once she taught her students, like all they would have to do is practice it, practice it, practice it, and they would master it. And she asked this question. She says, "What happens to professional gamblers who can count cards in casinos?" Right? I mean, you walk into a casino and you start counting all the cards and making tons of money at the table. Like it doesn't matter, even if it's fair, even if it's true, even if what you're doing is totally normal, if you're standing out from a crowd as the only person that can consistently win, what do you think's gonna happen to this? What's gonna happen to you in this casino? You're gonna get freaking kicked out, dude. 100%. Casino will say, "Get out of here. We don't want you," and they'll kick you out. The casino always wants the best odds, and if you're counting the cards, you're not making that. You're not doing them any favors, right? And so they will sort of exclude you and say, "Get out of here," because they want to make money, right? Now, what's cool is like you learn to count the cards of Wall Street. You learn to sort of rig the market and to keep winning over and over and over again. This is what you guys have been working through with technical analysis, right? You learn to sort of count the cards, and the cool thing is that you can't get kicked out of the stock market. So, like that's sort of the dream. That's the goal here. Is to figure out how to get super good and then just leverage that to absolutely crush it. Because, as soon as you can really know where these investments are going to go, like no one can stop you from profiting from it over and over and over and over again and leveraging, or you don't even have to leverage. I mean, you just make the investment and absolutely crush it. And as soon as you do that, I mean, it's just bam, huge over and over and over again. It's like going to that casino. Except instead of it being a casino, now you have the odds in your favor. Everything is sort of balanced towards you, and you know that like, look, I can do this, I can make these investments, and I can absolutely crush it with them, and do it over and over and over again on a consistent basis. So now, with technical indicators analysis, it's not gambling, but it's actually just a proven business system practice. So just sort of a cool little metaphor that I kind of thought of a lot when I was starting out, is this idea that you want to make everything in your favor, which is really, really, really cool. So yeah, fun stuff. She talks about some of the earlier days with her mentors here, which is super, super, super cool. But not. This is sort of some of that basic underlying fundamental stuff that you guys have sort of been learning along the way here. He talks about this idea that like you can be completely right and lose all of your money. Here he's talking about this idea of like, getting in an option contract and then you don't have enough time, right? So you get sort of a shorter options period, and you know that a stock's going to go down, 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 but it doesn't actually go down until your contract expires, and then you just needed to buy a little bit of extra time because if you don't actually have all that time, then what happens is you make $0, right? So this kind of comes back to this idea that we've been talking about with options, we've been talking about with investments, that you always want to make sure that you have enough time to make those investments. Also talks about like some of her first weeks on the job, and she asked her mentor like what book she should start out with, and like in a split second, he said that she should read Reminiscence of a Stock Operator, which I think is pretty cool. I'll leave the book review for that down below. But she does like sort of explicitly mention it here, and there's like a giant picture of the book in here, which is kind of cool. It's pretty solid. I'll leave all that information below. Definitely some cool stuff. It's super old, and I don't know. Like if you're like deep in the stocks, like I just love reading old investment books because it's like wow, they were trading on like fractions of a dollar. Like they were trading like literally eighth increments of a dollar when that came out. And to sort of think about how you can apply it today and the psychology behind it, it's just super, super cool. And then she just kind of talks about this underlying psychology, allowing yourself to do the same thing over and over again and just following your principles, following the indicators, following the technicals, and just sort of like you've got sort of this set, of rules that you follow, right? And you just do one, step two, step three. And obviously like this order, right? This idea of like whatever you're doing can just continue. And this changes, if you're doing long-term investments versus short-term investments. If you're looking pre-market gainers versus looking at sort of swing trades based off of this idea of technicals on dark pool stuff and looking at what big investors. But it all comes down to just following the system over and over and over again and just going through the process, going through the steps, which is pretty cool. Some cool stuff there. You want to follow that checklist and just do it over and over again. This is kind of cool. So a long time ago, like brokers could close your account if you're making a bunch of money and if you were crushing it. And so she kind of talks about how she interviewed this guy, and this is the guy who wrote Reminiscence of a Stock Operator. And he was literally kicked out of his broker after he made millions and millions of dollars because he was so good at trading. So I thought that was kind of cool. And it's always good to learn from people that get kicked out of their broker for making too much money. I thought that was pretty funny. Yeah, so he wrote that book, which is pretty cool. And here's sort of the meat and the bones. I mean, this is the core foundation here. This is what matters. She talks right here. She introduces the foundation of everything, and it's this idea of dark pool prints. Now, remember, these are literally just, looking at the orders that people submit, right? So you have sort of this feed you're looking at, and in this feed, you're going to have a lot of orders that have, a specific price, and then, this is for, stock XYZ, right? And so they have their specific price, and then there's the amount. And then there's a time. Now remember, the time is not really that reliable. The time, we have a lot of situations where basically, people, they're gonna lie about the time, or they're just gonna not report it on time. So that's sort of the foundation of these four different types of dark pool prints. These investments, right? When they come up, you want to look like everything, like every single thing that comes across here is going to be called a print, right? It's just some big trade. The amount is probably going to be like 100,000 shares, or 500,000 shares, or maybe 700,000 shares, maybe 8 million shares, right? Blah 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 blah. And so those are going to be sort of some of the investments we'll be looking at here. And the way that you sort of differentiate between the two is by looking at the price and then looking at the time. And so the four core types here, and we're only going to focus on a couple, but here's the four core. Okay, so you got 1, 2, 3, 4. First is pretty big. It's this idea of real time prints. And we're going to go super deep into all these, but the core with these real-time prints is like this is what you're seeing in the moment. This is what's going on live every single second of the day. And you're seeing everything come out as it comes out. These are usually the ones that are basically like the least delayed out of all of these, right? So say the time is like 10 or 11 in the morning. These might have taken place at like 9 or maybe 9:30, maybe 10. So these are pretty close to like the actual time of trading day. And you can tell that these are real-time prints because like the time is not going to tell you the time of the actual trade. The time is just going to tell you when it gets published, right? So the time is not something that you can really base too much trust on. What you want to look at is you want to look at the price, right? So if a stock's trading at like $35, right, and the say someone trades like 100,000 shares, and they trade those 100,000, say it's $35.64, and they trade those 100,000 shares at $35.80. Those are pretty close numbers, right? So you can tell based off them being really pretty close. I'm gonna say the trading range is like 37 up here to like, I don't know, 34 down here for the day so far. You can tell that this is a pretty close to being a real-time print just because the actual price is really close to the current price. So that's sort of the foundation of real-time prints. Now after that, you have late buy prints. Now again, we're gonna go super deep into all these, but this idea of late buy prints is pretty foundational. So say trading 500,000 shares. Now, obviously, this is going to get reported at whatever the actual time is, right? It's going to get reported at the same time as everything else. But say instead of being at 35, these are at, we'll say maybe 33.97. So now all of a sudden, these are very, very, very close to the low of the day. Or maybe they're actually below the low of the day and they happened yesterday. Because remember this idea that they can go overseas and they can delay it for an entire day. Or maybe it just happened and maybe it's in the trading range, but it's really, really, really far away from the current price, right? So the current price is way, way, way above, 34 bucks, right? It makes no sense. If you look at like a normal market, right, you have your normal level 2. Like if the level 2 is at 35.50 and maybe 35.51, like that, those are the prices that the stock's going to trade at. It's not going to trade at 34. It just won't happen. The stock has to move all the way down to 34. You don't have that happen in normal markets, right? That's just the foundational level 2. That's the foundational market depth. If somebody's willing to pay $34 for something, I'm not going to sell it for 30. Like no one would do that. And so that's how you know that this trade happened in the past. This trade happened in a time period where the stock was actually cheaper. Which usually is going to be, a couple of days in the past, looking towards that past, right? So you can tell, the idea here, right, is you can't actually tell when you look at this whether or not they buy or sell. Like this will not tell you if they buy or sell. But what you want to look at is the current price and then the price that they exchange it at. And if the current price is above the price they exchange it at, then what you want to assume is that this is like smart money buying, and that they bought it and then it went up a whole bunch to what the current price is. And your idea when you look at these late buy prints, and we'll look at what these really, really mean later on, this idea that they got in low, the price went up a whole bunch, and they were buying a bunch. They were buying at the bottom because the price has gone up a whole lot since they bought. That's the core, that's the idea behind these late buy prints. Super cool stuff. Now, after that, you kind of have the opposite, right? You have late sell prints. Now, what's cool is with these late sell prints, it's the same concept. So instead of being maybe at $34, say these would be sort of at like $37.05, right? So this, if this didn't happen, you would see sort of the same thing. If the price is at 35 and these guys have an order that went through at 37, you know that this had to happen in the past. This had to happen in a time when the price wasn't at 35 or wasn't at 35.65 or 35.50. Like this happened, and what you want to assume is that since the price is now actually lower than the trade, right? This is the spot price. This is the current price. So we talk about a 9 to noon. Since this is actually lower than what the trade was at, you want to assume this was smart money selling, and then they sold at the top, and now it's going down a whole bunch. And so that's the core. That's the idea. That's the foundation. And what's cool is you guys will kind of see are that whatever these levels at, wherever these trades are, these are actually going to act as really, really, really strong support and resistance levels on your investments. So you can use these as pretty solid price levels where you have really, really big buying and selling from institutions, because you know that that's where the big investors are sort of seeing the trading range on these investments, which is really just some powerful, powerful, powerful stuff there, which is pretty cool. So I'm going to go, we can do some cool yellow here. This last one is one that we're not going to use sort of as much, but it's pretty important, and it's one that we'll dive into on its own a little bit separately, which is super cool. And it's this idea of market on close prints. So these are sort of kind of as they sound. You have a market order, it executes at the close, but you don't hear about it till the close. And we'll kind of dive deeper into this one soon, but it's not really as foundational. The real foundation here is this idea, you've got your standard normal real-time prints, and those are the basics, those are the foundations. Those are just, the live feed, and the price isn't too far away from what the current price is. It looks like somebody just submitted a really, really big order, and now you're going to look into the future to see where the price is going to move. You're going to see whether it's going to go up or down in the future. Versus sort of these late buy prints where people bought really low in the past, and now the price, like now that you see the price it actually executed at, the price is way above that right now. And so you can tell that this was somebody buying because the price went up. That's a really, really big concept that we're going to dive into. Really, really deep. This idea that if the price goes above where the big boys buy at, then they bought and it's going to go up. And if it goes below that, then they sold and it's going to go down. So that's sort of where you get this idea of late sell prints. Same idea, right? Now that you see this price that they exchanged at, the current price is way below that. So they were selling, and now you're going to see the price drop because of that. So that's sort of the foundation. That's the basis of what we're going into. You're looking at really, 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 really big orders, and then you're looking at the price of the underlying stock, the underlying investment, when those get published to the marketplace. So super cool stuff, super foundational stuff. But really the core of what we're looking at here are the 4 key types of prints. Really the 3 that we'll focus on, which is pretty huge. So yeah, really, really cool stuff, guys. Cannot wait to get into some examples, get into some application, and then just apply it and absolutely crush it. So super cool stuff. Hope you got a ton of value from this module. Go out there, apply it, absolutely crush it. And I'm super excited that you have this basis, because now you can actually go throughout the rest of this course and know exactly where these investments are coming from and how to apply them. So cool stuff, guys. I will see you in the next module. Thank you so much. Bye.